Duolingo stock fell about 25% this week after reporting earnings. The earnings were actually pretty good. Pretty much everything grew double digits when you look at their metrics, but the market really didn't like the guidance that management provided for the next few quarters, and they didn't like how the management was going to refocus on growing the user base rather than revenue. They're going to focus on the long term. For some reason, the market didn't like that. I love that because I'm a really lazy investor and I just want to buy something and hold it forever. So we're going to take a look at the financials of Duolingo and see if I want to add this to my coffee can compounding portfolio. All right. So in ticker, we're going to look and see market cap 9.3 billion, enterprise value of 8.2, which I really like. I like to go to the balance sheet first and see how much they're diluting shareholders. So if we scroll to the bottom over here, let me move my head a little bit. All right. So we got a tangible book value of 1.2 billion. So I like to subtract that for a company like this with really no net working capital. I like to just subtract that from the market cap to get my adjusted enterprise value, which will be roughly 8 billion after subtracting the tangible book value, because they don't really need any tangible net assets in order to operate this business. It's just an application. So then we'll go over to the income statement. I'd see this is just a freaking sexy chart. Holy cow. Amazing revenue growth. 40% per annum. I don't expect this to continue in perpetuity, but my checklist is pretty much, is it going to be a bigger company, and am I going to own more of the company in 20 years? And if that's the case, then it's likely going to be a decent returning stock. But also I'd like the owner's earnings yield to be higher than whatever the going rate is, which is like 10-year treasury of about 5% right now. Alright, so looking at this, I like the revenue. I just want to see that the net income is actually like accurate. Sometimes they have weird reporting. So I'm just going to take a look at that. Asset write down. Income tax expense. So right here, this is an irregularity. So the income statement is going to be deceiving because they had a $235 million income tax refund. And so the real earnings are 150 million. So we have to totally ignore this earnings figure. This is just a one-off. So we just have to assume it's 150 and then minus tax, like 140 is probably what they're going to be doing. Alright, balance sheet, total shares outstanding growing about 2% per year. It's probably going to slow down in the future as the company matures and starts gaining more cash flow and repurchasing stock. So next we're going to go over to the cash flow statement. Remember, this earnings figure is total BS. That's about 150 million. Stock-based comp, 130 million. So the income statement generally will subtract stock-based comp out, so that is expense in the income statement, but it isn't in the cash flow statement. So if we look at cash flow, 150, so then if we subtract 130 for stock-based comp, what is that? 130 minus, okay, so we have 220. So 220 is about the adjusted owner's earnings that I'm getting out of this right now. But it's also growing, and they have room to expand margins if they wanted to. All right, so 220, rather round down, play it safe. 200 is going to be my going rate. And then we'll look at ratios. Good return on equity. It's a very new company, so it's not very mature yet. So I like to calculate. I'm just on my phone right now. I'm going to calculate what the earnings yield is on this. So 200 divided by 8 to 8,000. It's about 2.5% earnings yield. So I generally like to see that at like about 5% earnings yield with a company that I expect to be bigger in 20 years. I do really believe in this company, though. I think it's going to be substantially larger in the next 20 years. And if you just look at their historical growth rates, they're expected to grow like substantially in the coming years. And so 2.5% versus the market at about 3.3%. Is this a higher quality company than the S&P? Definitely, in my opinion. And also, these are suppressed earnings because they're not maximizing for cash flow at this point in their life. They're maximizing for user growth. So they likely could get like twice as high a cash flow yield if they really wanted to right now, but they're going to push for long-term growth. And so, to me, I'd say it's a buy at this point. I really like the valuation based on like how much they're growing in the future. And also, if we just look at projections, it looks pretty good. So, yeah.